This is Greg Rand from Own America, and this is a portfolio review of San Antonio number 953. This is a 25 unit single family rental portfolio of Section 8 rentals. The asking price is $2.621.6 million. And a couple of things I want to address. I'm going to walk you through our portfolio analysis just to kind of highlight a few things for you and also show you how these analyses work so that you can go and crunch your own numbers and use the interactive features here. The first thing I want to identify is that it's a Section 8 portfolio, which means subsidized housing, government paying the rent. A lot of investors we know are a little nervous about Section 8 because it tends to mean lower priced properties, tougher neighborhoods. It intimidates them, but the upside, of course, the reason why Section 8 attracts some investors in a big way is that your government paid rent. You get the vast majority of your rent paid by the government at the beginning of the month. And what makes SFR kind of cool when it comes to Section 8 is that other forms of subsidized housing tend to be densely concentrated, which means there's neighborhood risk when there's a high propensity or high density of subsidized housing. If I scroll down, I'm going to go all the way past these charts and go to the map for a second. This map is kind of cool because it shows that these properties are spread out all over neighborhoods across San Antonio. So it mitigates some of that neighborhood density risk. And this is also kind of cool because a lot of people will prefer to have a portfolio clustered in a section of town. But other people look at this and say, hey, I'm making an investment in San Antonio. I like the idea of having a sampling across many, many different neighborhoods and school districts around San Antonio, and you get that with this portfolio. So worth noting. Up top here we have our financials and assumptions, and this is a portfolio, again, a $2.6 million asking price, a 13.5% gross yield, which is a solid 2 percentage points above what we normally see anywhere in a major metro in the state of Texas. So that's worth noting. Here, our expense load with our assumptions is 31%. You can modify any of these expenses and change these assumptions. And so I'll do that right now and say that, let's say our property management is going to be a 10% property management fee. And that's going to change my expense load and my net yield. But this is still pushing a 9% net yield, which is a testament to a lower price point, roughly $100,000 per unit. And the rent being relatively high as a percentage of the value of the property. But here, this is something that's kind of a specialty at Own America. We have our total rate of return, which is very simply the net yield plus a price appreciation index. And I know a lot of people in this business that mystify me because they won't project HPA. They'll say things like, it's all about yield, and appreciation is a bonus. Now, I can tell you that a lot of the biggest institutional investors that were clients of ours over the last number of years, they said things like that. It's all about yield, appreciation is a bonus, but they went public on the appreciation. They won on the appreciation. The yield gave them the ability to return on a current basis. It gave them the ability to have staying power and wait for the recovery, but that recovery came, and now we're solidly in recovery territory, and the appreciation is very solid and it's pretty predictable if you do it in a certain way. Our price appreciation index is 3.73% on this portfolio. Let me scroll down and show you where that chart comes from. This is one of my favorite charts in all of our analysis, and it's the 20-year price appreciation for the market where the portfolio is compared to the state where the portfolio is compared to the country. And I love it for a couple of reasons. One, it's common sense. This is a long-term annual average. So on this chart, you see Democrats, Republicans, high rates, low rates, wartime, peacetime, economic boom, recession. You see everything under the sun in one 20-year chart. And it also gives you the dimension of comparison between geographies. So for example, the blue line here is the US. You can see the lead up to the boom. You can see the boom. You can see the crest. You can see what you can tell now is a correction. But back then, a lot of people who didn't know what they were talking about referred to it as a meltdown and a free fall. But look what happened. It made its way down to where it wanted to be all along. So this was a predictable correction given the steepness of this uptick. And then it got back to an equilibrium, which is very comforting for an investor to know that this market pushed its way back to where it intended to be all along. And that was, in the case of the country, a 3.44% annual appreciation rate. The state of Texas, you can draw a conclusion from this, or at least an observation, that it didn't really party as hard as the rest of the country. And so it had a much more short-lived hangover. And it certainly has picked back up again exactly where it wanted to be, even a little bit better from the long-term trend line. And I can give you one little nugget of insight into why that in part was. And that is that one of the things that drove home prices through the roof back during the boom times was speculative home equity lending. And the state legislature in Texas, with the cooperation and the endorsement of the National Association, of the State Association of Realtors, which surprised a lot of people, they resisted, they passed regulations against some forms of speculative home equity lending, which did tamp down on the party and therefore the hangover. And then here is the county, which is Bexar County, San Antonio, shows a little more volatility, but in general, it still shows, and what it shows me is here's the equilibrium line, and I see upside. If you hold a piece of paper across this line, you're going to see that the marketplace of San Antonio still seems to be looking to catch up to where long-term it wants to be. I find that to be very attractive. But in the end, straight numbers, national average 3.44, state average 4.14, county average 3.73. That number is the one that makes it into this calculation for the rate of return. And we show you this knowing that you may be underwriting on yield and you can't count on HPA. But when you see a portfolio in San Antonio, Texas, doing a combined return of 12.7%, show me a place you can have a predictable, dependable, reliable investment generating those kinds of returns unleveraged. Okay, unleveraged. These projections right here show you your cash flow growth with a 2% increase and a 1% increase in rent, increase in expenses. And then the equity buildup over time based upon this appreciation rate. You can change these assumptions, click this button, update the charts, and see the way the projections change. So if your threshold is I want to invest in these things for 15 years, I can look out 15 years and see if my assumptions held true, how much would I be making in equity, how much would I be generating in cash flow at the end of that period. There's that map again. Here's each individual property, and it just goes to show you the price points are a high of 129, low of 60. They hover around the 1 to 105 range for the most part in this portfolio. And our system allows you to go into each individual asset and underwrite the asset individually if you want to, which is a nice feature. And then as I scroll down, we get to the market fundamentals. This is where we talk about how this is taking a position in a great American city, San Antonio, and the population trends that feed housing demand can be read. And here we go. Here's population change in Bexar County, Texas over the last 20 years. Okay, it's always been good. There's a pretty substantial uptick and no letting up whatsoever. Okay, that is very, very driven by quality of life, cost of living, and job growth. We know these things. You read the headlines, you know the talk, but now you've got the ability to look at the data. And what I would say was if people were thinking about making a move on a portfolio like this, my first question is, do you think this chart is going to reverse itself? Is there anything on the horizon that would give you an indication this chart could reverse itself? If the answer to that is no, then from a fundamental, foundational perspective, this is a pretty good investment. Migration patterns show the outbound versus the inbound. So the green lines are the inbound, outpacing every year on measure. Unemployment rate, again, an observation against the state of Texas. So in good times, it tends to have a substantially lower unemployment rate. It rocketed up during the recession to above, and then as the market began to improve, overall, unemployment is now below the national average. And then one of my other personal favorites is job diversity. In this case, 17.5% of Bexar County is government. I don't love seeing government in first place, but if I see it less than 25%, I'm not worried. Number 2 is right up there. That's trade, transport, utilities, then education and health, then professional and business, then leisure, hospitality. So you have a business city that also happens to be a tourist city, which that combination is unusual. Cities like Charleston, Nashville, they have that going on, and it's an awesome combination. And then from there, financial services, et cetera, et cetera. So take a look at it. Don't forget that when you look at the portfolio visualizer, you can monkey around with the assumptions and watch the charts and projections change. You can download a spreadsheet right here to use your own modeling system, and you can make an offer right here. Thanks for watching.